You said to Mr. Fallon that you stand and fall by your reputation. How have your sales been affected since 2008? How have your gross sales been affected since 2008?
I apologise, I'm going to have to ask you a second time. How's our
gross sales? So how's your income for Standard & Poor's been affected? So you said that you stand and fall by your reputation.
Yeah.
Reputation in 2008 was not the best.
Yeah.
How has the market reacted to that in terms of your ability to sell your
I don't have access to that information,
you can give us
so I can't tell you. I mean, clearly what I do know generally is that obviously our model is fairly significantly correlated to just, activity in the market, debt issuance in the market, and therefore issuers' desire to come to us for ratings to then access the market. And obviously, over the last year, 18 months, 2 years, we've seen a very significant downturn in activity. But I do not have access to that information.
I mean, my whole point behind this is I've heard this before, that rating agencies' reputations stand or fall by their they stand or fall by their reputation. And yet, what I'm trying to get a handle on is, have issuers turned away from you at all? Because, notwithstanding the fact there's been a reduction in the issuance, have they turned away from all of you as a result of the fact that clearly you got it wrong in 2008?
I can certainly respond to that question. We haven't really seen any unusual degree of withdrawal of ratings. Certainly in the European context, there is an existing market of unrated issuers. Those are typically smaller size companies who have determined that they have a sufficiently strong brand and determined that they do not require rating to be successful in the capital markets, and that certainly is an option. But in general, we haven't really seen a change in the degree of interest, both on the investor and on the issuer side.
So actually nothing's changed for the rating agencies. You still have the same market share, you still do the same level of business. You haven't fallen at all by your reputation hasn't fallen at all.
That is correct.
Okay, fair enough. Mr. Drevon, you also answered questions by my colleague John Mann a little bit earlier about the local authorities who were coming or were looking at the rating agencies' ratings on particularly Icelandic banks. And I think you said that they should not rely on rating agencies. Well, an awful lot of people relied on them. I mean, Wild Forest District Council, who I represent, lost £9 million on 3 Icelandic banks. They would argue that they were relying on you to come up with some ratings for security, and now you're saying that they were foolish to have listened to you?
I don't think they should rely exclusively on the work and the ratings we provided. I think again
Who should they rely on?
They should be relying on their own research. They should look at the ratings. They should look at the underlying research we provide. They should look at additional research which is provided by the marketplace.
I mean, let's be serious about this. There are huge numbers of people who are out there who are relying on some sort of advice. A district council or district councillors are elected to go along and do a whole number of different things: planning, licensing, all sorts of things. They also have a certain amount of cash. They go out and they buy in investment advice. Those investment advisors are relying on you. There's a huge amount of money, and even the smart guys, even the audit commission, lost a huge amount of money as a result of taking the advice of rating agencies. And those guys are boffins.
So they should have had a diversified portfolio. So
they did. They had 3 banks.
So they should therefore understand that some ratings will always prove not to be the accurate assessment of what happens in the future. But there's a built-in level of loss assumption in an investment portfolio.
So you said a bit earlier that I think, what is it, a 2% failure of AAA rated anything?
Triple B rated.
Triple B. Well, these were AAA rated banks.
No, they weren't.
What were they?
Single A probably.
Okay, so the single A rated banks, 3 of them. All the banks in Iceland went bust. Well, that's pretty amazing. Okay, so from now on, people should not rely on rating agencies.
No, that's not what we're saying. We're saying it's a statistical.
There's an awful lot of very,
extent.
very upset people out there who, particularly taxpayers in some of these local authorities that John Mann and I represent, who are furious at this, absolutely furious. You're talking about libraries being closed down as a result of people relying on you guys.
So you need to understand the product and how it should be used. So there is always going to be a degree within
so
the ratings.
who would you blame? Would you blame The,
there's no blame. We've got to distinguish between the subprime crisis, where there was a failure of the market, including the rating agencies, to identify what was going on there, versus it's not a normal situation, but a 10, 20-year situation where you should assume that some investment grade ratings will fail. That's what the default statistics tell you. So if you're telling me I have to predict every default that comes up with 100% accuracy, then that's impossible.
All the banks in the country.
We can't do that. There are thousands of single loan.
And the other point is that you're talking about rating, obviously debt issuance, but in fact, in the case of the of banks, people are looking at them in terms of getting an idea of whether they should put money on deposit or not. You say that they should absolutely not use the rating agencies for that type of advice at all.
No, we're saying the rating is a good indication of long-term credit quality. There will always be exceptions to that being a black and white definitive, because we can't predict the future perfectly.
Getting back to the conflict of interest, and thank you, Mr. McFadden, for asking so many of my questions. In 2008, the Chartered Financial Analyst Institute did a survey of which 211 of its 1,959 members surveyed reported that they were aware of credit rating agencies changing a rating as a result of pressure by an investor, issue or underwriter. When asked to specify how this pressure was manifested, 50% stated that it involved a threat to take future ratings business to other CRAs, and 17 mentioned the offer to deliver more business to the agency. Isn't that quite a damning indictment that issuer pays is got us quite a strong conflict of interest?
I don't know the piece you're referring to and how it was created.
2008 Chartered Financial Analyst Institute report. But it is a big issue, isn't it? People have been talking about the fact that issuer pays has got a substantial conflict of interest.
We're back to the point we talked about earlier, which is there is a conflict with issuer pays, as there is a conflict with any other business model. You have to identify and manage that conflict.
How would a new rating agency break into the market? I mean, if you look at the experience of Crawley, who've been going around trying to work on a model of investor pays, they've been going around and eventually gave up, so now they're looking at a model of issuer pays. But how does a new entry come into the market?
It takes a long time and a lot of investment. So DBRS are doing what we were doing 10 years ago. There have been a couple of comments from people earlier about the three dominant players. That's wrong as well. We had a 17% market share. S&P and Moody about 40%. So there's not a dominant three, there's two.
So there's 40% each?
Yeah, business. I'm talking business, not number of ratings, because you can have unpaid ratings out there. So market power, influence, business. There's a difference. So you have to spend a long time knocking on doors, talking to investors, explaining your methodology, introducing them to your analysts, convincing them that what you're saying has some value and that they should listen because it may give them an insight into the future credit quality of an entity. There's no short-term solution to that. You just have to pound the pavements and do it, and invest the money to do so. Invest money in people. So you're doing that now. We're still doing it. It takes a long time. There are new players in the US who are doing it. Morningstar have just announced a move into corporate ratings. They have a large parent behind them to fund it. But it's a long-term process. There's no short-term solution. And sorry, just to finish on one comment, we think rotation will actually limit competition amongst European agencies. We think it will have the complete reverse effect of what the Commission is intending to do.
Would any of my colleagues like to ask any more questions? We will have another opportunity to examine some of these issues because we're going to be holding a hearing specifically with respect to sovereign risk. And we'll be sending invitations to a number of you to attend that. I have to say, on the basis of the reaction and questions from a number of my colleagues this afternoon, it does appear that you've left the committee unconvinced that many of the problems that attached to risk rating agencies in 2008 have yet been adequately addressed. And I think there's deep concern in this committee that these problems simply have to be tackled, not least the conflict of interest, lack of competition, and the fact to some degree that a number of you don't even feel you have anything to apologise for. And I think this is deeply concerning. But we'll return to this at a subsequent hearing, and thank you very much for coming today.
Thank you.